Good morning and good afternoon. My name is Jesse Serrano. I'm one of the market managers here at BackNine Insurance. Thank you for joining us today. Today's webinar is going to be slightly different. I had an advisor ask me if we could help him with marketing and presenting to his clients various insurance strategies. So I started creating for him some customized consumer-facing webinars that he could use and record and send out to his clients. We've now done a few of these and we're having some amazing results. So what you'll be listening to today is actually a consumer-approved presentation that of Legacy Marketing helped us co-host. It's a conceptual presentation, meaning he wasn't out here pitching about how great his products are. It's a simple introduction to the various types of annuities that may be available to your clients. He does a great unbiased job and also debunks some annuity myths that are out there. I promise you that even though it's a consumer-facing presentation, you as a producer will still learn something new. The best part is that we have permission to replicate this presentation for your clients. At the end of this webinar, I'll be giving you my contact information if you're interested in getting a copy of this presentation customized for your clients. With that said, let's listen to Bruce.
That an annuity is a contract with a life insurance company that provides benefits in exchange for a deposit of money known as premiums. Although annuities are not life insurance, they're kind of the opposite of life insurance. So life insurance pays our beneficiaries upon our demise, whereas annuities are designed to provide benefits primarily during lifetime. So whether it be accumulation or guaranteed lifetime income, or safety from market fluctuations, there's a lot of different mechanisms that come into play during our lifetime. So annuities are kind of the counter side of the life insurance policy, which has a benefit only upon our demise. Now, if you were to look at the different types of annuities, they fall into really 4 different categories. There are the traditional fixed annuities. With a traditional fixed annuity, we invest our dollars, our premium, with the insurance company, who then, through their general accounts, make various investments, primarily bonds, and from those bonds they generate interest. That interest, after costs of, issuing the policies and administration of the company, that net yield is then passed on to us as consumers, where we would expect to experience in today's interest rate environment maybe 1%, 1.5%. Potentially 2% interest. So traditional fixed annuities are not as in vogue today as they were in higher interest rate environments. Multi-year guarantee annuities are kind of our CD alternative type of solution, where we have a stated interest rate that's guaranteed for a period of time. Typically that's 3 or 5 or 7 or even 10 years. Again, a lower interest rate environment, these are not as popular as they were 7, 8, 10 years ago, yet they're still available. I've seen some multi-year guarantee annuities with 3.5% guaranteed for maybe 5 years, something like that. Fixed index annuities are really one of the most popular categories, along with variable annuities. So fixed index annuities have had a meteoric rise in premium deposits year over year, one of the fastest growing categories, because what the fixed index annuity does is it gives us upside growth potential tied to a stock market industry, thus the word indexed. Typically, you're looking at the S&P 500 for probably 80–90% of sales in our industry. So the upside growth is tied to a stock market indice. But the unique mechanism here is that there is no downside risk. So a fixed index annuity takes the interest rate yield, typically that would be associated with a traditional fixed annuity. Instead of paying us 1.5% or 2%, the insurance company buys an option on the upside of the stock market. If the option expires useless, there's no cost other than the premium for that option. But if the S&P were to drop, for example, that expires out of the money, there's no net negative felt by the consumer. So the popular expression in the fixed index annuity world is that zero is our hero. Our worst case scenario is if the stock market were to decline, we don't experience any loss. Yet at the same time, we have a significant upside potential that may be, the first 3 or 5 or 7%, some number like this tied to the upside of the stock market. Again, the most popular version is the S&P 500, but there are many iterations on that. Variable annuities have been around longer than fixed index annuities, and basically a variable annuity is a group of mutual funds with a tax deferral wrapper on them. And variable annuities have experienced a lot of innovation over the years, but what they don't have is that protection from the downside. We've seen the advent of many riders. Variable annuities are known for the good, the bad, and the ugly, but the good being innovative riders, the bad being higher cost. So a lot of the negative press you see around annuities are specifically speaking of the higher cost associated with a variable annuity. So there's some things to be aware of, in these different categories. If we were to look at our investment pyramid and to identify where these different types of annuities fit, stocks and derivatives are really at the high end of the risk profile for the investment pyramid. In the middle, due to diversification primarily, are variable annuities and mutual funds. And then at the bottom, of the safe category, where we don't risk principal, are CDs, savings accounts, annuities, and fixed index annuities. So, depending on your age and your risk tolerance will dictate how much should go into each of these three categories. And then for some people, it's not appropriate to have dollars in all three. If I'm more conservative, I may just stay on that bottom tier and try to maximize my yields and opportunity because I'm not comfortable with risk. If I am more comfortable with risk, some of the other opportunities open up. At the top of the pyramid, these are typically reserved for accredited investors or at least a certain risk tolerance. So that's how we really categorize these different types of annuity opportunities. So why would anyone be benefiting from ownership of an annuity product? Well, first of all, the number one reason that people purchase these products is safety. We want sleep insurance. We want the confidence that when the stock market is volatile like it is right now, that we don't have to worry about the downside, the down capture. Flexibility. Most products in the marketplace today have an extreme amount of flexibility, whether it's 10% penalty-free withdrawals or liquidity provisions that occur if our health were to change in the future, such as confinement to a nursing home. That would be concern for people if I'm in a long-term solution like an annuity. If I have a change in my situation, can I access the value of my policy? Death benefits are another thing that we look at as far as flexibility. Third thing, why an annuity is earnings potential. In today's world, the average 6-month CD across the nation pays 14 basis points. That's 14% of 1%. So basically, it will take us a decade at the bank to make 1%. And if you want to make 10%, it's going to take more like 100 years if interest rates don't go up substantially. So based on where we're at today, the earnings potential CDs is pretty much been mitigated. At the same time, to chase return potential in the stock market, where most experts are saying you're going to be lucky to make 6 or 7% into the future, and you do have the downside risk. So this is kind of in between there, where we're going to have guarantees and the opportunity to make 3 to 5 to maybe even 7%. And then in protection. So safety and protection are kind of the same thing, but there are certain protective features built into the most innovative annuities today that will help us deal with all of life. So of an index annuity and compare that to, what's it mean in layman's terms. Tax deferral is a feature, but what tax deferral does for us is it allows us to enjoy triple compounding of interest. We'll walk through each of these. Minimum guarantees. What's that really mean? It means safety and security. The ability to name a beneficiary and avoid probate. That's important because we don't want our private financial affairs published in the newspaper and subject to probate court, which is very expensive and time-consuming. The ability to have annuitization, or the benefit there is guaranteed income for life. Control, and that gives us choice and flexibility. Death benefits allow us to leave a legacy to our children, our grandchildren, or charity or church or whoever or whatever entity we'd like to receive the dollars we don't spend in our retirement. It used to be you saw bumper stickers on everybody's car that said, "I'm spending my kid's inheritance." I don't see those so much anymore, but most of the people I talk to are, their number one concern is not running out of money during retirement, with the legacy concern being secondary. But all things being equal, would rather leave it to our families, our chosen heirs, than to the government or the probate court. Withdrawal provisions create income stability. Premium bonuses is very popular opportunity on a lot of products. Premium bonuses allow us to offset losses that we may have incurred or repositioning costs. A lot of times people are frustrated with their CD yields and they want to move it, but there's a substantial penalty if you break your CD. 6 months of interest in many cases. Those bonuses can not only help offset that, but we can also take a tax deduction brought on our tax returns, for the CD interest penalty. And then optional riders. There's a lot of optional riders. In fact, that's probably the biggest innovation today, is the ability to have lifetime income riders, doublers that create additional dollars if our health were to decline, death benefit riders. They can either offset the impact of the RMD or income withdrawals or these types of things upon death. So there's a lot of those types of things that we look at today. And then crediting methods. My favorite solutions today give us the ability to choose not one, but multiple crediting methods so that we can ebb and flow with our product throughout whatever the future holds. We might see strong stock market opportunities. We might see opportunities that are tied to other indices like real estate or gold, or some of the more innovative solutions in today's marketplace. So if we were to focus on that first thing called tax deferral, tax deferral is often attacked. If you listen to the radio, they say, if you have an IRA, why would you own an annuity? Because IRAs already have tax deferral. Well, that's a misinformed comment. That's one of those myths I like to bust. So tax deferral exists as a function of law, and there's no explicit cost to it. So there's no additional cost to have your IRA be invested in an annuity, for example. But what tax deferral does is it gives us interest on our principal, we like that, interest on our interest, and then interest on dollars that we otherwise would have spent in taxes. That's for what we call non-qualified money or cash. Can go into a non-qualified annuity and get interest on our principal and our interest and money we otherwise would have paid in taxes. If it's an IRA, you actually get quadruple compounding because you got a tax break up front, and then you get these 3 different ways to earn interest. If you have a product that has a increase upon death, a death benefit rider, that also contributes to a quadruple compounding situation. So really at the end of the day, how many ways do we want our dollars to work for us? Just one? Or would we prefer it to work in 3 or even 4 different dimensions? That's the secret of the ultra wealthy, is that they make their money work for them many different ways. Minimum guarantees. Minimum guarantees are really kind of worst case scenario. So if we go into an index annuity and let's say that all the stock markets decline for the entire term of the contract, then what? Well, there's a minimum guarantee. Every fixed index annuity contract has a minimum guarantee. That doesn't apply to variable annuities. It only applies to fixed index annuities, multi-year guarantee annuities, and the traditional fixed annuity. So what minimum guarantee in many cases in our industry today is that it will compound 1% on 87.5% of your money, or compound 1.5% on 87.5%. About the strongest end of that spectrum is 1% on 100% of your premium, which means, over a 7-year contract, for example, that you're guaranteed to make a $7,000 return on a $100,000 deposit. Or on a 10-year, it would be about a $10,000 return. So, we have this fallback position that's created via the minimum guarantee. A lot of people will compare that to, other guarantees. Like if they were at a bank, we know FDIC guarantees our deposit up to a certain dollar amount. But what FDIC doesn't guarantee is an interest rate credited. So on the insurance side, on the annuity side of the equation, this contractual minimum guarantees not only on the principal, but also some interest earnings as well. All right, so this is maybe one of the most important things for us to all consider, is that annuities allow us to name a beneficiary, a specific name beneficiary. Now, in a typical situation with a husband and wife or a married couple, the spouse is going to be listed as a sole primary beneficiary. That creates the ultimate flexibility, because then, upon my death, my spouse can either take over the contract or accept the death benefit or do whatever she wants to do. So I recommend, unless you have a non-typical situation, typically you want to list the spouse as a sole primary beneficiary, because it gives them the most flexibility. Also, in IRAs, you always want to name a living beneficiary, because it allows the option for that beneficiary to not pay all the taxes in one lump sum. They can actually stretch the IRA over their entire lifetime, and potentially even a third beneficiary. And make that retirement asset last potentially 100 years and continue the tax deferral in the meantime. So the other benefit here is that it allows your assets to avoid the public, costly, time-consuming process of probate. Probate's a very bad word because of the expense, the agony, the time frame that's required to get through that. So here's an idea. A lot of the contracts that you own, insurance contracts, annuity contracts, mutual funds, IRAs, have the ability to name a beneficiary. It's important to sit down, beneficiary review. I recommend once a year, because things change, we lose track of things, and we've seen so many times in the financial planning industry, an ex-spouse was still named as the primary beneficiary, and that's, you want to keep up with changes in your family situation. If the beneficiary's predeceased you, limits the options available to your estate. So it's important for planning perspective to make sure that you're updating your beneficiaries on a regular basis. Annuitization, this is an option in most contracts. Some companies require it, but most annuity products give it as an option, which means you don't have to do it, but you may want to. So this gives you the ability to exchange your value of your contract for a lifetime stream of income. It's been said that we focus a lot on accumulation years. Not a lot of people are talking about how to properly decumulate or distribute those dollars that we've accumulated. And this is one powerful option that can provide what's referred to as a mortality credit, i.e., a lot of people buy a lifetime annuity, for example, and some people die early and some people live a long time. Those that live longer get additional benefits in the form of higher dollars paid out for a longer number of years due to the what's called a mortality credit. That's something that should be explored, especially if there are limited dollars, or if you want to make a certain asset be maximized for income purposes. Or if you don't have heirs, this would be another thing to look at. So that can protect you from outliving your income and give you tax advantage solutions on non-qualified monies too. There's a lot of products. One concern that we often hear expressed is, I don't want to tie up my money for a long time. But then when folks truly understand the control that's built into these products, where we control how the heirs can receive the death benefit. If I have a spendthrift in my family tree and I want to protect them from themselves, I may choose to say, hey, you can only take out the RMD equivalent of this IRA for the rest of your life and never have access to a lump sum. If I'm concerned about them making their own choices, I'll have to do that. But I can also choose when to pay taxes on the gains. I can choose crediting strategies. I can choose if and when to take income. I can choose the duration. Probably the shortest duration in the marketplace that I'm aware of, as far as a surrender charge duration, is a 3-year commitment, but we also see 5 and 7 and 10 and 12 and 14 and 16, and all of these exist for different reasons. There's none that are bad. It's not that the longer ones are bad and the shorter ones are good. There's a lot of options depending on what your objective is. Different premium bonuses, types and amounts. There's a lot of different riders, a lot of different solutions. In fact, there are probably out of the top 25, 30 companies that are focused in the annuity industry. If you combine all the products that those 30 companies offer, there are probably 500 plus different products to choose from. So that's why we always recommend working with a professional to help you navigate, the different opportunities and to understand what your needs and objectives are. Death benefits, I think that probably some of the biggest innovations today are in death benefit riders. So, all of us are required by the government to start taking distributions from our IRAs when we turn 70 and a half, whether we want to or not. The tax deferral game starts to end at age 70 and a half because we have to take these distributions. If you find yourself saying, do I have to take an RMD? The answer is yeah, you should, because if you at least about 55%. But the death benefit riders can help reimburse the effects of those RMDs back into your contract so that you can leave to your spouse, your heirs, the full value or close to the full value or an increase off of the value of what you otherwise would have. So most annuities today offer full value of death, so full accumulation value of death, surrender charge waived. Some offer this additional type of death benefit rider to either help offset the tax burden or reimburse the RMDs or just really enhance the estate opportunities. A lot of different settlement options are available to the heirs, and in many cases the surviving spouse can continue the contract if it's set up properly, which again is a good reason to review the beneficiaries. So if you want to leave a legacy and optimize the flexibility for your beneficiaries, that's the way to do it. Liquidity provisions. Again, if I'm hesitant to a longer-term commitment, I'm going to take solace in the fact that I've got income flexibility, whether I want income now or later, fully liquid at death, liquidity upon confinement. Even some of the most innovative solutions today offer checkbook access, or actually write a check against the value of your contract. And then again, as I mentioned, optional riders like income riders, death benefit riders, additional benefit riders for changes in our health, those types of things. So premium bonuses are an optional bonus in many contracts that are available today that can just give you a jump start to your accumulation, offset market losses, increase your values, and create additional income. So, that's another innovation. Optional riders. You're seeing a lot of living benefit riders, income for life riders, additional benefit riders. There's typically some type of a nominal cost. I say nominal. It could be anywhere from 30 to 50 to 70 basis points, even 1.5 points per year if you choose multiple different riders. And I'm speaking generically across the industry. A lot of different living benefit riders that create lifetime income, where even when our account balance has been drawn down to zero, we still get a lifetime income. We still get that paycheck, if you will, throughout retirement. The death benefit riders, may increase significantly the beneficiary's net inheritance. We have additional liquidity riders. They're focused on your health. So if for example, if I could not do 2 of 6 what's called activities of daily living, like I need someone to come into my house and prepare meals and help me, get ready for the day or something like that, that can be very expensive. But I really don't want to go to the nursing home, because I just find a stay at home. I just need a little bit of help. There's a cost for that. And an income doubler would be a liquidity type of rider that would fit there. That would take my normal income and double it, so that I have additional benefits to pay for that in-home care. So that can really help dignity of life as our health changes. So that gives us a lot of opportunity. As far as crediting methods, there are very, very many opportunities out there. Either a current interest rate guarantee, there's multi-year, there's a lot of different index strategies, S&P 500, and a multitude of other indices today, different crediting calculations that you don't really have to be an expert on. That's why you should be working with a qualified financial professional. This is why you should call Rod, sit down, and work through what are the different opportunities that you can take advantage of today. Probably the most common conversation we have is comparing CDs to annuities, and this one goes back for a very long time because there's a lot of similarities between the two solutions, but there's some key differences as well. So with a CD, as we earn interest, we have to pay taxes on it. Even though the national average yield is only 14 basis points, we still have to pay taxes on it. So 14 basis points in most tax brackets mean you keep about 10 basis points. CDs are and have been at historically low interest rates. Even though the Fed just recently raised interest rates a little bit, they're still pretty paltry. Very limited liquidity. In many cases, you're not even allowed to withdraw your interest, or if you can withdraw your interest, that's about it. You don't get 10% free withdrawal. They may be subject to probate, and they can be subject to creditors. Now, annuities offer tax deferral. We talked about the triple compounding, also upside potential. Free withdrawals up to 10% most contracts, and perhaps, depending on the product, also a checkbook may be available, ability to avoid probate by naming a named living beneficiary, may have additional creditor protection, so there may be some additional liability protection to you, and other solutions available via these writers we've discussed. Just over time, the ability to pull ahead of a stated interest rate with the additional compounding growth of tax deferral, you can see on the chart the dark red is the tax deferred growth versus the taxable growth. So the opportunity here is to put yourself in charge of when you pay taxes, and choosing not to pay taxes until you need access to the funds can put you in a lot better position over time. Here's some equivalencies. These are a little bit out of date because we don't see 4% tax or 5.56% taxable accounts anymore, but this slide was really built in a different interest rate environment, but I think it puts it in perspective. I think we can all remember 5 and 6 and even 7% CDs. It's been quite a while, but we can remember them. Tax deferral doesn't have to work as hard because it creates a leverage point. So a 4% tax deferred yield is equivalent to about 5.5. 5% tax deferred is 6.67. So I think we can definitely make the case here, especially in today's interest rate environment, of greater opportunity within the annuity. And the reason for that is that typically the insurance companies have a much longer duration, whereas the 6-month CD, they're basically sitting in cash and they don't have much yield. So in the form of disclosure, there's a lot of different things that come into consideration, a lot of different criteria. And again, I can't emphasize enough, there are over 500 choices out there. Don't try to do it yourself. Pick up the phone, call Rod, sit down, go through what your objectives are, what you're trying to accomplish, what your financial plan looks like, so that you can make the most appropriate recommendation.
All right. Well, thank you again for listening in today. As I said, if you're interested in having a customized webinar made for you and your clients, whether it's on annuities, you want to do a webinar on max funding life insurance to create a tax-free retirement, or whatever you feel would best appeal to your clients, please give me a call. And I would love to hear your thoughts and help you co-host a webinar. Thank you again. Make it a great day.